Welcome to the deep dive. Today we're tackling a really interesting tool for traders, the Moving Average Convergence Divergence indicator.
You probably know it as the MACD.
Exactly, the MACD. And look, even if you think you know it, we've been digging into some material that we think offers a fresh perspective.
Yeah, our mission today really is to properly understand this indicator, not just surface level, but, its components, how they interact, and how it can potentially flag trading opportunities.
And we're basing this deep dive on a YouTube video from the Niraj Joshi channel. It's called Never Miss a Trend. MACD Indicator Trading Strategy MACD Divergence. Seems packed with practical stuff.
It really is.
Okay, so the basics first. The MACD, it's fundamentally a trend-following indicator.
Meaning it generally moves with the market's flow.
Precisely. So in an uptrend, it tends to point up and down in a downtrend. Pretty intuitive at that level.
And it's got some history, too, introduced way back in, 1979?
Yeah, by Gerald Appel.
Yeah.
Investment advisor, wrote over 17 books, apparently.
Wow. So it's definitely stood the test of time. Speaks volumes about its perceived usefulness.
It does. And it's pretty versatile, isn't it? Good for short-term traders, swing traders, maybe even provide some context for longer-term folks.
And the source mentions something interesting, potential for smaller stop losses when using it.
Yeah, that was a point they made. Could allow for tighter risk management if the signals are timed well.
So for anyone listening who wants to follow along, how do they actually get this onto their charts?
Right, good question. The video covers the standard way. You go into your charting software, find the indicators section usually.
Just search for MACD.
Yep, search MACD, click apply, and boom, it should appear below your price chart.
Okay, so it pops up. Might look a bit complex initially, lots of lines and bars.
It can, yeah. But breaking it down helps. And the video stresses checking the settings first. There's usually a little gear icon or something.
Definitely important, understanding the inputs, because the MACD isn't magic, right? It's built on something else.
Exactly. It's built using Exponential Moving Averages, EMAs.
Ah, EMAs. We've touched on moving averages before, haven't we? The original video points to a detailed one on those. EMAs give more weight to recent prices, correct?
That's the key difference, yeah. Makes them a bit more responsive than simple moving averages.
So the MACD leverages that responsiveness.
It does. And the standard MACD uses 3 specific EMAs.
Yeah.
You've got a 26-period EMA, a 12-period EMA.
Okay, a longer one and a shorter one.
Right. And then also a 9-period EMA. Those are the kind of the engine parts.
Got it. So visually, when you look at the indicator panel and maybe check the style settings, what are the main things you actually see? The video breaks it down into 4 parts.
Okay, first up is the MACD line itself. It was blue in the video's example. This is often called the fast line.
And that represents the difference between the 26-period and the 12-period EMAs we just mentioned.
Exactly. It shows how those two averages are converging or diverging, hence the name.
Makes sense. Okay, what's the second line?
That's the signal line, orange in the video, sometimes called the slow line. And this was actually simpler in concept.
Oh, yeah. How so?
It's just a 9-period EMA of the MACD line itself.
Ah, okay. So it's a smooth version of the first line. Gives you something to compare the MACD line against.
You got it. Then component 3 is super simple but important, the 0 line.
Just that horizontal line right across the middle.
That's the one. Value of 0, the baseline. It tells you instantly if the MACD is positive or negative overall.
Right. Above 0 or below 0. Clear distinction. And the last part, those bars.
The histogram,
Yeah.
those green and red bars, they visually show the difference between the MACD line and the signal line.
So if the MACD line is way above the signal line, you get a big green bar.
Typically, yes. And if it's way below, you get a larger red bar below the 0 line. Think of it like momentum visualization. Bigger bars, more oomph.
Okay, so the histogram itself gives clues about momentum. Above 0 suggests, what, bullishness?
Yeah, bullish momentum. And below 0 usually suggests bearish momentum is in control.
And the size matters. Taller bars mean a stronger trend, more conviction.
Right. The video also made a neat point about lighter red bars potentially signaling weakening bearish momentum, like a subtle heads up.
Interesting nuance. Okay, so we understand the pieces now. How do we actually, use this? What are the trading signals? The video laid out 4 main approaches.
First one is probably the most common, crossovers.
Ah, the classic MACD line crossing the signal line.
Yep. So a bullish signal is when the MACD line, the faster one, crosses above the signal line, the slower one.
Suggesting momentum might be shifting upwards.
Potentially.
Yeah.
And conversely, a bearish signal is when the MACD line crosses below the signal line.
Downward shift potential. The video also mentioned the location relative to the zero line adds weight,
It
right?
did, yeah. A bullish crossover above zero might be seen as stronger, and a bearish crossover below zero perhaps more convincing. Context matters.
Okay, crossovers. What's the second method?
Double tops and double bottoms,
Mm.
but in the MACD indicator itself, not just on the price chart.
Oh, interesting. Like the patterns we see in price, but reflected in the indicator's movement.
Exactly. So, if the MACD forms two peaks, two tops, at roughly the same level,
Mm-hmm.
that could be a bearish signal, hinting that the upward momentum is stalling and price might reverse downwards.
And the opposite for double bottoms. Two troughs in the MACD at similar levels, suggesting a potential upward price reversal.
You got it. It's like the indicator showing exhaustion before the price fully rolls over.
Cool. The video mentioned a free course on chart patterns, too, for those interested in that more broadly.
Yeah, seems like a good resource. Okay, method 3 for using Anki-D. Back to the histogram.
Right. Just reading it directly. We kind of covered this, but it's worth reinforcing. Above zero, bullish. Below zero, bearish.
And crucially, the height of the bars indicating the strength of that momentum. Don't ignore the histogram.
Absolutely. It's a core part of the picture,
Right.
which leads nicely into the fourth method, which is maybe a bit more advanced, divergence.
Ah, yes, divergence. This is where things get quite interesting. The video covered two types, histogram divergence and MACD line divergence.
Okay, let's start with the histogram. Bullish divergence first.
Right. So picture this. The price on your chart is making new lower lows. It's still trending down.
Okay.
But you look down at the MACD histogram and it's making higher lows. See the disconnect.
Ah, I see. Price going down, but the momentum of the down move, shown by the histogram troughs, is actually lessening.
Precisely. It can be a clue that the selling pressure is drying up and a reversal higher might be coming.
And bearish divergence is the mirror image. Price makes higher highs.
But the histogram peaks are getting lower, suggesting the buying momentum is fading even as price inches up. Potential warning of a downturn.
Got it. Okay, what about MACD line divergence? Same
Yeah.
principle.
Oh, core idea, yeah.
Yeah.
Bullish MACD divergence. Price makes lower lows, but the MACD line makes higher lows.
Again, signaling potential upward reversal. The video recommended using candlestick patterns for confirmation here, didn't it?
Yes. Strongly recommended. Get that extra confirmation before acting.
Makes sense. And bearish MACD divergence. Price. Higher highs, MAD line. Lower highs. Warning sign for a possible drop.
Exactly. And again, look for those confirming candlestick patterns. It's about building a case, not just taking one signal blindly.
And the video pointed to more resources there too. Courses on candlestick, support resistance, even RSI. Shows how these tools often work best together.
Definitely. No magic billet. Okay, let's talk time frames. Always a big question. What did the video suggest?
It broke it down by trading style. For intraday traders buying and selling same day, maybe options traders too.
Yeah.
Shorter time frames make sense, like 5, 10, maybe 15-minute charts to catch those quick moves.
Right. What about slightly longer holds? Few days to a week.
For that kind of short-term or swing trading, the 1-hour chart was the main recommendation, though maybe 30 or 15 minutes could work sometimes.
Okay. And long-term investors.
Well, fundamental analysis is really key there. As the video stressed, they even mentioned a big course on that.
But if using technicals like MACD for context,
Then look at daily or even weekly charts. See the bigger picture trends.
makes sense. Match the tool's time frame to your trading horizon. Okay, let's get practical. The video used the crossover strategy as an example for actually placing a trade.
Right, a common starting point. So for a buy signal, MACD line crosses above the signal line. The suggestion was to enter the trade on the next candle after the crossover completes.
Okay, wait for confirmation and risk management. Stop loss.
Crucial. Place the stop loss slightly below the low of the candle where the crossover actually happened. Or maybe a nearby swing low for extra cushion. They mentioned another video just on stops too.
Good. And targets. How do you know when to get out?
Couple of ideas there. You could use a trailing stop loss to lock in profits as price moves up, or
Look for that bearish divergence we talked about as a signal the move might be ending.
exactly. Use the MACD to potentially signal an exit too.
Okay, and for sell signals, MACD crosses below signal.
Same logic, just flipped. Enter short, or maybe buy a put option on the next candle.
Stop loss goes above the high of the crossover candle.
Generally, yes, especially on shorter time frames. On longer ones, maybe a slightly closer recent high to manage risk size.
And for exiting a short, look for bullish divergence.
Here was the suggestion, yeah. A sign the downtrend might be losing steam. And throughout all this, remember the histogram
Right.
size.
Bigger bars after a crossover add confirmation, suggesting stronger momentum behind the signal.
Definitely. And the video hammered this home. Practice first. Paper trade. Don't risk real money until you're comfortable.
Absolutely critical advice, and always use stop losses. Non-negotiable, really.
Couldn't agree more.
So, wow, we've covered a lot of ground on the MACD,
Yeah.
from its basic construction with EMAs
Yeah, the MACD line, signal line, zero line, histogram.
to interpreting those components, and then the 4 key ways to use it: crossovers, double tops, bottoms.
Histogram analysis and those divergences, both histogram and MACD line.
Plus, thinking about time frames for different styles and a concrete example using crossovers, always focusing on risk management.
That Niraj Joshi channel sounds like it has quite a bit more, too. RSI, moving averages, other useful topics for traders.
Seems like it. Worth exploring further if this area interests you.
So maybe the final thought to leave you with is this. Now that you've got a deeper feel for how MACD reflects momentum, how might that change how you look at market trends?
And building on that, what other tools or indicators could you potentially combine with the MACD to create a trading strategy that feels, well, more robust and suited to you? Something to think about.